Ladies and gentlemen, my name is Greg Michalowski, Director of Technical Analysis and Client Education for ForexLive.com. And this is a special webinar for FX Street. I'm going to focus a little bit on trending or non-trending, why that is so important, and whether or not you can anticipate a trend. Before we get started, let me remind everybody that trading foreign exchange carries a high level of risk that may not be suitable for all investors. In addition to that, leverage creates additional risk and loss exposure. Should you decide to trade foreign exchange, carefully consider your investment objectives, your experience level, your risk tolerance. Traders can lose all or part of the risk capital in the foreign exchange market, so be aware, be prepared. If we can figure out trending or non-trending, what would that do to your trading? I think it would do a lot. We first need to define what trending really means. What is a trending market? Well, a trending market to me is fast directional and tends to go further than expected. Fast directional and tends to go further than expected. Those three things are important to understand in a trending that define a trending market. Is they go one way, and they also tend to go further than you expect. Just take a look at the euro versus US dollar action in trading here today. Who would have expected that the really kind of a trend move to the upside here after the gap lower? We gapped a lot to the downside and then kind of consolidated at the bottom, and then spent the rest of the day trending to the upside. Who would have thought that, and who would have thought that it would go as far as it did? I certainly didn't. I had levels that I thought the market would stay below, or a level, some technical tools that I used to help define a top side that I thought the market would be my line in the sand, that the market would stay below, but that was quickly overtaken, if you will, and we'll take a look at that in a little bit. But these types of that's what characterizes a trend, that they tend to go fast, they tend to go directional, they tend to go further than expected. So they can be quite painful for us, can't they? They sure can. So now those characteristics of a trending market kind of occur after the fact, okay? After the fact of what of the move. So they don't really necessarily do us any good. Nevertheless, well, they do a little bit, but nevertheless, if we could be on the right side of a fast directional and a market that faster directional market, and one that goes further than we expect, we would do really well in our trading. Don't you think? I certainly think so. That's why trends are so important to me from a profit standpoint, from a positive standpoint, from a from the measure that we are measured by in the market. How much how are we making? How much are we losing? Now, on the opposite side, if we were on the wrong side of a fast directional market that goes further than we expect, we would not do well. In fact, we might just blow up our account, and that is not very good. So you can see the importance of trending markets, and I know it's a kind of a cliche that the trend is your friend. Well, the trend is more than your friend, ladies and gentlemen. The trend is really the nuts and bolts and the alpha and the omega, if you will, of your trading. If you don't focus on trends and trading with the trends, you can get really hurt. Just imagine the people getting hurt with the market squeezing to the upside and trading here today, and has been a slow, steady squeeze. And again, thought we'd take a look at that a little bit later. So the question comes, if the characteristics of a trend are fast, directional, and tend to move larger than we expect, is there a way that we can anticipate a trend move before the fact? Before the fact of the market moving in a fast directional way. And if we could do that, wouldn't that be great? Wouldn't that be super for our P&L? After all, markets moving our way in those types of characteristics, and it's going to go further than we expect. all we have to do is get on the trend. Get on the trend. Always harder than people think, but we need to. That's why we need to focus on this idea of being on the trend and understanding what a kind of a trend is and what it implies for our trading. So we can certainly try to do that. Try to anticipate a trend move, and there are certain ways that I've been able to find. And I remind everybody of the fact that the best of the best in the world find ways to anticipate what might happen in the future. Let's take a look or think about Apple. Apple is one of those companies that somehow are able to see the future. They're able to create a demand for their product that just keeps on giving. At first, it was music, and we had the iPod, that turned into a new generation iPod, which turned into the smaller one that you can sit there and run with it, or take it to the gym, and or put comfortably in your shirt pocket. Without it drooping your shirt back down. They had an uncanny ability to create these products that created demand for other things. Going back, to or thinking about the music. So the vessel was the iPod, but then they also had the music, and the music came at 99 cents a download, and so it's like a dollar before you know it. Everyone in the world who has an iPod has a bunch of music on their iPod, don't they? At a dollar a piece. Now that I think about 25 or something like that now, but so it revenues start to go, and then they do the iPhone. It's hard to imagine life without an iPhone, isn't it? That was spurred on by having developers create apps, for their iPhone that increased the demand for the iPhone, and so they were able to anticipate the future in ways, and always have been able to anticipate the futures in ways that a lot of companies have not been able to mimic, or other companies, let's say, wish they could do. And I'm sure it's like anticipating the future is something that all companies look forward to, or have planning sessions on and stuff. But Apple seems to be one of those companies that really excel at that idea. So now we have new products coming out of Apple with the iWatch and stuff, and I wouldn't be surprised if developers start to develop applications that are going to make life easier for you to look at your watch and sit there and click a button and order a meal, or to do a lot of things I don't even know, but I'm sure they're anticipating ways that watch is going to sell. Of course, we will see, but I wouldn't put it past them, would I? So that's Apple. That's a business. Now we also have athletes like Lionel Messi, who has an uncanny ability to see the future as well, not only where he should be, but where his teammates are on the pitch, and how he gets the ball, and also the defenders, and how he's going to react to them, and corner kicks, anything. I mean, for someone who's 5'7" tall, he gets around the pitch a lot and seems to find the ball and be able to put the ball in the net. Not at will, certainly, but at an extraordinary pace in relation to anyone else in the world. So that makes, so what is it that Messi can see that other soccer players can't? Well, the fact is, a lot of professional athletes are very good at being able to anticipate the future, and to be able to see the future. In fact, there was an article in one of my favorite sport magazines called Sports Illustrated here in the United States a few years ago. That was about this fact, how athletes are able to anticipate what may happen in the future before anyone else says. And the article was titled, "It's All About Anticipation." And they subtitled it this: Ryan Howard and Rafael Nadal Ryan Howard's a baseball player, by the way, and Rafael Nadal is, of course, a tennis player. People People probably know him more than Ryan Howard, but they don't have quicker reflexes than you do. They hit the fastest pitches and return the hardest serves because they can see the future. That was written by the author David Epstein of Sports Illustrated. That's an interesting comment, isn't it? That they don't have any faster reflexes than you and I do. These are professional athletes like Rafael Nadal, but they are able to see the future. What does that mean? Well, he went further on in saying that they read the clues, reading the clues. Fast reaction time helps, but what really makes a good baseball player and tennis player for that matter is ability to process the nuances of a pitcher's throwing motion or the nuances of a server's serve. How else could you hit 100 plus mile an hour serve or a pitch that's going the same thing, same speed, 100 miles an hour from a short distance away? It seems implausible. It seems impossible. Yet these athletes have been able to train their minds to be able to anticipate the future by understanding the nuances of a pitcher's throwing motion or a server's serve. In other words, they're able to see by a pitcher's arm angle, for instance, or by his exertion at the point of release of a baseball, where that ball will plane out and where it will go. Now, they obviously don't always hit every serve square, every pitch square, but they have this uncanny ability to be able to work through, their minds are able to work through those nuances of it and be able to see the future. So we as traders, I've switched this around a little bit, and I said fast reaction time helps. But what really makes a good trader is ability to process the nuances of the market's motion, So we, as a trader, are able to, as we get more and more experienced, can actually start to react to the what we see in the market and what we've become accustomed to in the market from things like price action. And for me, it includes the tools applied to the price action. So what are some of the nuances of the market that may be able to help us anticipate a trend that's fast directional, tends to go further than we expect? And one of the simple things that I've said to myself and to other traders in regard to this idea, and this is really a simplistic way of looking at the market, is non-trending transitions to trending and trending transitions to non-trending. So if you're able to find or see or define a non-trending market somehow, some way, would that help you to anticipate a trending market? Just think about it. When you can close your eyes and visualize it in your mind, but we know that markets, a trend of a market will tend to, either go to the upside or the downside. And then the market tires, and what does it do? It starts to go sideways. It starts to move up and down. Maybe there are it gets more choppy. We do what I call laps, where the market will move all the way to one extreme, come all the way down to another extreme, sometimes in the same day. Now, in a trending market, again, close your eyes and think about it. Do you see those types of reactions? Do you see the market moving, doing a lap, going to the top side and testing, going to a high and then going down to a low and then moving back to the top side? Not really. That's not necessarily a characteristic of a trending market or a market that's moving in a directional bias, fast and farther than you expect. So these that example, just seeing the market move higher And lower and higher again is a nuance that the market may be transitioning from a trending market to a non-trending market. And the same goes true for when the market eventually moves out of this non-trending phase. It'll eventually start to trend. It won't have those characteristics of the up and down choppy trading. Maybe it will find levels against some technical levels that mean something from a bullish or bearish standpoint. There may be some ways that the tools give us a clue that the market is non-trending, and non-trending, we can prepare ourselves to anticipate a trend, much the way a athlete or a business prepares for the anticipation of a new trend in their business or on the field of sport. So just understanding this very simple comment, non-trending transitions to trending, and you can reverse it around and say trending transitions to non-trending, is a way that we as traders can have an ability and a ability to see the future, to understand little nuances in the market that will allow us to potentially catch a trend. So if the market is non-trending, anticipate a trend. Now, we don't know when it's going to happen. A market can non-trend for an extended period of time, but it's always been my belief that if you're not anticipating a trend, you have a worse chance of staying on that trend and having the fast directional and larger trading range work in your favor. And so you have to start somewhere, and that becomes start to anticipate a trend when the market is non-trending. So so why do markets go from non-trending to trending? Another simplistic reason that or statement that I guess I can make is this, is that no one makes a lot of money when the market is non-trending. Yeah, the market moves up and down, but yeah, you're going to get on the wrong side of one of these choppy type of moves, perhaps, and you're going to give some back. You're going to make a little. You're going to give some back. You're going to make a little. I've always found that the non-trending choppy markets can be somewhat frustrating. That's my personal opinion. Some other traders may be able to trade them well, but oftentimes that means they don't trade trends all that well, or maybe they can, and but generally speaking, okay, the most important people who are in the market, in the foreign exchange market, are really not us retail traders who may dilly-dally in the market moving to the upside or the downside, non-trending market. It really is the bigger players, those big boys, as some people like to call them, who will come in the market and move the market. And when the market's non-trending, do you think they make a lot of money? Do you think those guys who have the big mortgages and the big payday and big bonuses and who are measured very closely by their managers as far as how they make money or lose, whether they make money or lose money, do you think they're making a lot of money? Do you think the hedge funds who are paid to make money and get more money from the rewards for the more money they make, do you think that they are happy when the market's sitting there non-trending like it did last year around this time? What do we have last year? We had the World Cup going on, right? And everyone was fixated to their screens, including the dealers out there. In addition, at that time, we were also in the middle of a Forex scandal where the government officials and regulators were really up the banks, probing for any little irregularities that they may be having in their trading. And the combination of those two things led the market to stagnate so that the range The month-long trading range in the summer of a year ago was about 44 pips, 44 pips for the euro versus US dollar. Now that's extraordinary, especially this day today, where it's a year later. Maybe not, well, it may, yeah, I think the World Cup was going around June of this time last year. I think the low in range came in July and August, however. But at this point, right, a year ago, or where we are right now, the range today is about 140 pips from the low to high. That's a 100 pip difference. It did take until around August, September, after the World Cup, after the summer, before the market started to really start to move in one direction. And my theory is that, well, the World Cup was over. Also, summer was over. Okay, we'll take that. And then where things tend to get a little bit quieter anyway, and we'll probably not be without that this year either. But and also, it was enough time had passed for the regulators to kind of ease up a little bit. And so managers of banks started to say, okay, take on a little bit more risk. We got 3 months to go, boys and girls. Let's try to make a little bit more money and push the market around a little bit. And, that's my feeling about it. The Forex market has, we as retail traders only account for a very small percentage of the total volume per day. So we're kind of as I said last week during my course that I'm giving at Forex Live, that we are kind of like the barnacles on the back of a whale, aren't we? Barnacles attach themselves to whales, not because they're parasitic on the whale itself, but they're parasitic in that the whale moves along trying to eat plankton. And guess what barnacles eat? Plankton as well. So they just hop on the back there and get all the plankton that they want when the whale starts feeding, if you will, for its nourishment. Funny little thing. So we are like those little barnacles on the back of a whale as well. So we have to rely on those big boys to trend the market, and that's why the markets trend, is because there's lots of buying or lots of selling going on. And it's not going to be you and I moving the market. It's going to be who? The big boys, the larger players. So the larger players are the ones who move the market and will look to move the market and make money because they need to, just like a whale needs to fill up that huge mass of whatever with plankton and other stuff from the ocean. It's got to be more than plankton, doesn't it? Those little, I mean, I don't think you can see. Can you see plankton? I don't know. Anyway, I'm not a whale expert. I just read a little bit about barnacles one day. Thought I would make ourselves seem like barnacles. Anyway, so let's take a look at, we've been a lot of words here. Now let's take a look at a chart and show you a little bit what I'm talking about. And we'll take a look at some live charts and end it at that as well, because we'll take a look at today's action in the euro versus US dollar, perhaps. Oops, didn't mean to do that. But here's the, here's kind of a classic. This goes back to 2014 when the dollar was really going sideways here, for extended period of time. And I mentioned that I like to look at tools because price action is one thing. This is like a trend right here, but tools applied to the price action can tell us different stories here. I have trend line here. I have a couple moving averages here. This is the 100, this is a daily chart here, so this would be the 100-day moving average. And it's a simple moving average. This is a 200-day moving average. And one of the things that I always look for is moving averages moving sideways, okay? When you think about a 100-day moving average moving sideways, 100 days is a pretty long time ago in the world of trading, since we have a 5-day traded work week. That's what, let's say there's 4 or 5 weeks in a month, so 100 days. Well, you figure it out. I don't know, 100 days. So there's five into 20 weeks. 20 weeks of data going into making up the 100-day moving average. That's a long time, and 200 days is going to be more than that, or twice the amount, so 40 weeks. So that's a long time for, and then to have the moving average kind of go and sit sideways here for 2 or 3 months here, maybe 2.5 months. that tells a lot about the market. It's going nowhere, okay, and no one's making any money in here. And this is the summer doldrums, and this is when the World Cup was going on, and no one was really interested in their investigating the market at that time as well. So we had this sideways market until the market started to break out in August, and what we as traders look for is that breakout, okay? Is that breakaway? Look for different clues that other tools would provide us as well. For instance, if we have this low right here, we connect it to this low that occurred in July, we're looking for, well, something that might show that there's more bullishness or bearishness. Now, the bouncing off of the trend line is a little bit more bullish, isn't it? Now, going below the 100 and 200 day moving average is a little bit bearish. So during this part right here, I consider that the market's still pounding away at each other. It's still trying to figure out which way it wants to go. Does it want to go to the downside, or does it want to go to the upside? And it's my opinion that if the market would have gone below this trend line, that we would have seen the market move further to the downside rather than bounce off this 0.3 as it did. I'm just that way. I believe that the market will react to what it sees and different tools and what it sees as well, applying different tools like a simple trend line that connects a couple points along it. It will react to that. Now, it may have come down to this floor right here where we had this high right here and this break to the upside and this floor right here and this other floor right here. This is another one of those testy areas, very similar to over here where the market broke through the 200-day moving average here, and it should have gone lower, right? And it did, but it found support against what? This old low, and it started to rebound, just like it did here, fell below the 200. What do we find support? Against this old trend line right here. So it's the same thing over and over again, and these are the nuances, ladies and gentlemen, of the market. These are the nuances of the pitcher's motion, of the server's serve, that we as a trader have to grasp onto if we're gonna feed off of the big guys, if we're gonna be the barnacles on the back of the whales. We need to be able to see these things, to see these nuances, and then we have the ability to see the future. Understand that, well, we have a chance for this market to trend, and I'm anticipating a trend, so that's going to be a little clue. Now, what about over here where the market goes back above the 100 and 200 bar moving average or 200-day moving average and starts to feed off of the 100-day moving average, come down and test it, come down and test it. Look at how small these ranges are. Come down and test it, come down. That's 3 different times where the market came down to the 100-day moving average and tested it. And then we had this day where the market closed above the 200 after not getting as close to the 100-day moving average. It's still not that far away, but we didn't come down and really sniff that 100-day moving average, did we, on this day right here? No, the market instead closed above that 200-day moving average, and we started to see a little bit of nuance right here with this move to where the market just went straight to the upside on this day. We opened at the low and we closed at the high. Is that a little nuance that we as traders can grasp onto and anticipate that maybe this is something else? This is the start of something good. The start of something good. And if we're able to do that, folks, we have the best chance of catching the bigger moves as the price moves higher. You got to see these little nuances in the market. Don't fall asleep. Try to look for them. All right. Otherwise, that serve is going to go flying by you, or that pitch is going to go flying by, and you're going to strike out. It's not our. We don't want to strike out in our trading. We don't want to blow up our account. We want to get on top of these fast directional moves. Knock them out of the ballpark, or rocket those serves back and break the opponent and win Wimbledon, right? Whatever, umpteenth time Rafael Nadal has done. So what happens? Of course, these are those 2 days, that we'll move away from the 200 bar moving average and move above, and then we have the momentum move to the upside. Yeah, it takes a little while to get the steam going here. These are the people who got this move to the upside and couldn't wait to get on Twitter and tell them how they made this. They bought at 102.40 and they sold at 104 and they made 150 pips and they high-fived themselves. And little did they know that they had to move all the way up to the 110 before the next real correction in the move for the dollar versus yen. Oh, they shoulda, woulda, coulda. But that goes into the anticipating the trend, folks. When we sit in there in a non-trending range for so long right here, and the markets has a little nuance. It says maybe the little engine that could, maybe we can go higher, maybe we can trend higher, and it starts to move in the directional bias. Those are the times that you want to start to anticipate a trend. Remember, I said earlier that you need to anticipate a trend if you're going to stay on a trend. It's one thing to be in on here at this point right here. It's another thing to do that and be anticipating a trend. And ladies and gentlemen, that is what distinguishes, the Messes and the Nadals and the Ryan Howards and from everyone else is that they are able to see the future, and you as a trader have to be able to see the future as well by finding those little nuances and believing them, and more importantly, anticipating the trend. So one clue I look for to anticipate as a trend is when the 100 and or 200 bar moving average start to move sideways. This is indicative of a non-trending market, and you have to be ready for that. So here's the euro versus US dollar, just as another example. We're taking a look at the hourly chart. And by the way, trends to me, they don't have to be like the dollar yen moving from 104 to 110 and then up to 120 or whatever. They don't have to be that, okay? You don't need to catch and stay on trends forever. You can look for trends in the hourly charts as well. You can even look for trends in 5-minute charts if you and take advantage of those. People say, well, the market only trends 30% of the time. Well, to me, that's rubbish. Okay, here's a trend type move. Here's a trend type move. Here's a more of a non-trending type move. But here's a trend type move. This is non-trending, but that's a trend type move. I mean, this is a trend type move. This is where the market starts to go up and down, does its laps, and so we get a little non-trending. But there's a lot of trends in the market, and it's up to you to start to believe in them and look for them and try to find those opportunities. So here's the euro versus US dollar. What's a 200-hour moving average doing? That's the green line in the chart. I just use two moving averages, and I name them one. I name one blue and I name one green. And the blue one is the 100. The 200 is the green one. And so when the moving averages start to go sideways or converge, just another little clue for me. When the two moving averages and the price converge, it's always a red flag for me to start anticipating a potential trend. And maybe it's some news, this is, I don't know, May 13th, so it's after the employment. I don't know what happened on this specific day here. But if you start to see this dynamic right here, you start to be able to take advantage of it. Maybe you buy when the market moves above this high, when the market's moving outside of this range, narrow trading range here for the day, isn't it? And then starts to move higher. So you don't get necessarily on the 100 and 200 bar moving average, but notice here how the market did base against the 100 and 200 bar moving average right before the market started to take off to the top side. Sometimes always a little clues, these little nuances that allow you to get in on the market, or the market failed below here as it failed to break, like it did right here, failed to break below the broke below the 200, but failed to ignite any momentum to the downside. When the market breaks the 100 and 200, the market should go down. If it doesn't go down, what does it have to do? Go up. kind of like today's action, and we'll take a look at that in a second. But the euro versus U.S. dollar, also the 100 bar moving average started to get a little flat through here as well. You can see the slope starting to move a little bit. Came down to the 200-hour moving average, which is always already flat right here. Had a little breakdown, and I know it said I just said if it goes down, it should go further to the downside. But in this case, we did and eventually break to the downside. It's still the idea is still that we're looking for a momentum move, and we got the momentum move to the downside here. The market rotated downside. If you're aware of that, you can have the opportunity to take advantage of that type move. So here's what we were looking at there. When we came down to our bottom right here, what were some of the nuances here in the market that kind of looked a little different here? Well, we started to move above the 100-hour moving average. That's a little bit different right through here. And then we moved above this trend line, and then we came down and tested the trend line, went up to the 200-hour moving average. Had this kind of, the market's in what? The market's transitioning from a trending market to what? A non-trending market. Can you see that? Can you see the transition? This doesn't look like this. Okay, now it may look a little bit like this, but notice here the moving average here is doing what here? It's going to the downside here. The fact the slope is pretty steep to the downside right here. Is the slope really steep right here? No, slope's not really steep at all. And so we start to see the nuances of the market starting to show a little bit cracking that the trend might be over. We don't know for sure. This could be consolidation for a move to the downside, but eventually we get a move above the flattening 200-bar moving average here, and it's time for the market to move. Very narrow trading range through here, right? I mean, look how small it is compared to all these other bars right here. It's just inching a little bit above and a little bit below, and the market starts to move to the upside, and we start to trend to the upside. It doesn't take long for the market to move up from, this is an hourly chart again, 109.75 to 111.75 or 78. That's 200 pips to the upside right there in a matter of hours to the upside by little nuances in the market, little nuances that you could anticipate, that you can see beforehand. You can see the future before it happens. If you start to see these things, you are going to be able to take advantage of fast and directional moves. All you have to do is get on them, get on the right side. That's all you have to do, and just follow the market, follow the momentum. Another nuance of the market that could help anticipate a trend is when there are a few reasons, that should be to trade, whoops, to trade. And so I was going to go to some live charts here, if I could. And do you see my charts, by the way? Someone say yes. I assume if I move that thing out of the way, you can still see my charts. Yes, okay. So this is the euro versus US dollar, the big one, okay? Ignore these little ones on the side. But this is the euro versus US dollar, and we're looking for multiple reasons to trade, okay? Multiple reasons that will allow us to anticipate potential move and break away, if you will. And we can also, when the market's going to non-trend and then potentially trend, we're going to have instances where the market changes its directional bias, right? Changes it from being above the 100-bar moving average, the blue line in the chart, 100-hour moving average, and moving below the 100-hour moving average, or moving below the trend line, a trend line which is moving to the upside that has a number of different points. So when we take a look at this reaction here, we got to move below the 100 and we rotate it back to the upside. Another move below the 100, rotate back to the upside. Another move below the 100, and a smaller rotation. These are a little bit different. This little move right here is a little different than that one, a little bit different than that one. So a little nuance in the market, isn't it? That makes you wonder if we have the potential to rotate further to the downside. And all you have to do is just see little move back below the trend line, and you can define your risk against both of those levels, can't you? Against the trend line, against the moving average. And so you have multiple reasons to trade from and you're anticipating or potentially anticipating a move in a counter move than what it's been doing here, and the market started to rotate to the downside. Now, near the highs here as well, I'll go back a little bit here and take a look at these little nuances in the market. I kind of look for this type of formation as well, where we have a swing high right here, market moves sharply to the downside. Another swing high right here, the market moves sharply to the downside. These are nothing to sneeze about. Okay, these moves right here, where we have swing highs and come down, swing high that just takes out that previous high and comes down. Who's entering the market here? Sellers are entering the market here, and so you do see that selling mentality right there. Now we come over here and ignore this bar right here. But what do we see right here? We see the market move above those swing highs right there. And, what would you expect might happen here? You'd expect that the price would move higher through here. But what happens? We get this bar here where we go up and down. We start to move below our level here. We start to find sellers against what was previously our highs through there. And yeah, we have a little bit difficulty time here. This was a Greek headline that came out. I remember it clearly because I earmarked this area right here and said, is that it? Is that all the euro could do above that level? But some Greek headline said, Greece calls back the EU officials for a meeting. We saw this. This is first hour trade and started to rotate to the downside. Note here, we got up to about the 86 level, just above the 85 level, and boom, started to rotate to the downside. This is a trend type move that is worth about 90 or so pips. If you can catch on that trend, good for you. What do? We run into the 100-hour moving averages, and this is that first test of the three little failed breaks that we showed right here. By the way, if you sold through here, what would you do? You buy it back up here, and you want to see momentum on the break of the 100 at all times. And if you don't get it, get out. You don't mess around with it. You got to get out as soon as you can, because the market's could trend off of the 100-bar moving average. Here's another level right here that was a key level for this move to the downside. You take a low here, a low here. This is the FOMC day, where I don't know why the market went down on the FOMC day, but the market went down there initially off the headline, because there was a headline that said that the Fed's still going to tighten 2 times between now and the end of the year. Well, it didn't really say that, to be honest with you, but that was the headline, and I think the high frequency traders or the algo traders had that programmed in 2 tightenings or whatever, and it went down first and then shot back up anyway. So I ignore that that FOMC move to the downside, and I suggest that you do too. A lot of times these volatile moves off of I don't know, non-farm payroll this month, the market is much stronger than expected, and the dollar got weaker initially off of the number. I don't know why, but it did. But before moving to the upside, so sometimes you got to ignore the little tails here and reestablish the line. But anyway, that line came across right here against the 200-hour moving average, right at the same point. As soon as the market fell below that level, the market came up to that level, started to find sellers against that level, another move to the downside here. So these these nuances in the market that you're able to grasp onto, you're able to benefit from in your trading. So let's go to today, okay? Let's go to today in the euro versus U.S. dollar. The market gapped sharply to the downside, and you would expect that, with all the news that came out, that this market would zip further lower, right? And in the process, on the way to the downside here, I switched over to the daily chart. What did the euro do? This is the low that we saw in March. This is the high that we saw in May. And we fell below the 100-day moving average. We fell below this trend line. And we came right down to the 50% retracement of this move to the upside. I haven't talked a lot about Fibonacci retracements, but I'm kind of keen on the 50% retracement level. And it came in at 109.63.8 here. That's of this move to the upside. The market found or went down to a low of 53, not far after the opening here. Matter of fact, the low for the day came in on the second hour at the 53 level. We went where was that Fibonacci? Where was that 50% retracement level? Was at the 63 level. So I'm going to put a horizontal line here at the 63 level. Just to show you where it came in. So right around here, and I'm going to go with 5-minute chart as well. Might as well put a horizontal line on the 5-minute chart at the 63 level as well. And to show you how much time we spent below the 63 level. One 5-minute bar, two 5-minute bars, then we're above it. Then another 5-minute bar, we're below it, and the next 5-minute bar, I think we're back above it. Yeah, we're back above it. So I count 3 5-minute bars that we spent our time below the 63 level. And note here, the next time the market came down to this level, we came down to a low of 68, and the market bounced, and this low came up to 109.84. So little nuances in the market that kind of tell you, wow, I know Greece, I know that, but I still thought that the market would find sellers against the 100-day moving average. Okay, we gapped to the downside. We should stay below the 100-day moving average and below this trend line. This was going to be one of those battle areas in between the trend line, which came in around the 110.33-ish, and the 100-day moving average, which came in about the 110.50. So I expected to see some battle, for the market to go up to that level and start to rotate back to the downside. So that's like from the 33 level to the 50 level where the 100-day moving average is. Here's a 100-day moving average. Here's a 33 level right here. And lo and behold, the market came right up to the 33 level here and rotated to the downside. So what are the nuances the market showing us? It's showing us that the potential exists for the market to move lower and stay lower, stay below the 100-day moving average, and everything's okay. Well, we moved above the 33 level, and we didn't really find that much resistance against the 100-day moving average, did we? I'm going to put it on a minute chart here just to, I don't know, for laughs and giggles here. I'm going to move back to the time when the market moved. We moved up to about the 44 level here. It came back down below the 33, and then really took off above the 100-day moving average at the 110.50 level. And what was a low here? This low came in around 59.8, just about 10 pips away from our 100-day moving average. And that was it. That's all the market needed for the market to say, all right, well, if you don't want to go lower, we'll go higher. So traders came in against this level, bought the market. In addition to that, if you take a look at the move to the upside here, the market did, and this is a 5-minute chart, we had a lot of support here against the 38.2 to 50% retracement level, also against the 200-bar moving average on the 5-minute chart. And so I started to see some nuances in the market and not to mention the 100-day moving average here at the 50 level. So there's a lot of little support through here, 200-bar moving average on the 5-minute chart, 38.2 to 50% retracement level, 100-day moving average. Traders could define the risk and limit the risk against that level, and then the squeeze was on. The squeeze to the upside was on. Stayed in this sort of channel-y area, and then around the 11 o'clock hour, it broke to the upside, moving back above the another level that I had here at the 65 level. Where did that come off of? The 100-day moving average, or 100-hour moving average. This is the hourly chart. We moved above the 65 level, and we've been above the 65 level since that time. Haven't been able to move down back below it. Right now, we're having a little bit of a battle here, but the trend has been pretty steady to the upside here in trading. Not much in the way of and retracements or of the bears taking back control. So what was the nuance of the market at that time? It was getting about it was failing at this gap move to the downside and moving back above a key level, a key moving average, 100-day moving average, moving back above a broken trend line here. Those were the nuances that we saw in the market here today that helped trend the market further to the upside. So what going forward? What do we have to look forward to here? Well, if the market is not able to get back below this 100-hour moving average in trading here in the near term, we're going to see further upside potential here for the euro versus US dollar. We do have a key resistance area up here against 112.09. Let's call it 112.10 level. It looks like 112.099, and if we get above that level, then we could see another further move all the way back up to the 200-hour moving average. And who would have thought that, given what happened over the weekend? Not I, given the fundamental picture, but the technical picture tells a different story. Different story. All right, sorry, I'm going to wrap up here. And question here before I go: what is the lowest time frame to see a trend? You can see, you can start to watch little nuances in markets over the 5-minute period. I use 5 minute. I use the hourly and daily. And there's trends in all types of markets. What I want to see is lapping. Okay, doing those laps where it goes up and down. You notice here I put the Fibonacci retracement from our low to our 2% retracement. And the market rotated to the upside off of that level. So if it can hold this 38.2 to 50% retracement, that's oftentimes a time where you have the potential, or where the market has the potential to move to the upside. If you can add a 200-bar moving average or a 100-day moving average in that area right there, you're gonna have multiple reasons to trade. So kind of pay attention to little nuances like that. The key today was getting back above the 100-day moving average. You know, it shouldn't have gone above the 100-day moving average if it opens and gaps below that level, and it did. So that's just the way it is. So you got to listen to what the market says. The upper hand is moving the currency. Well, guess so. All right, I'm gonna call it a day there. I want to thank the people at FX Street for allowing me to have this opportunity. Hope you've learned a few little things, at least change your mindset to think about potential trends, and I wish you all good fortune in your trading in the markets. My name is Greg Michalowski. Have a good one. Thanks. Bye-bye now.